Brad Williams, Frugal Finance. Let's talk about volatility. Volatility investing. There are many tools on Wall Street. One is measuring volatility. What's volatility? That's the movement of the stock market up and down, up and down, up and down, the teeter-totter, if you will. And the pros on Wall Street, they use what's called the VIX Index, and I'll get to that in a second. And they can measure, and it's a sophisticated mathematical model in order to gauge this thing. In finance, it's pretty basic, but from an outsider, you would be you just go, what are you talking about? But it's pretty basic stuff. I'm just going to show you, I'm going to illustrate a couple different examples. I'm going to take you to a couple outside vendors, Yahoo Finance. They have some good illustrations that I'm just going to point out a few graphs on what it means, and then don't worry about the calculations. It's a matter of just understanding what this is all about. This is produced by FINRA, which is the quasi-regulated agency. It's self-regulated by the finance industry, sort of, well, the hen and chicken or the fox and the chicken kind of deal. Is it authoritative? Well, you need some type of regulation. FINRA does a good job. In other words, they monitor the broker dealers out there, all the registered reps, in other words, the advisors. They have to be licensed. I used to be licensed, just FYI, a zillion years ago. I'm just going to discuss a little bit about some of the tools out there, and this is one of the tools. Volatility investing, exchange-traded products include exchange-traded funds. You're going to see a lot of acronyms here within the industry, sort of like any other government-related or corporate-related conversation. There's always shortcuts. And here we're using these ETPs and ETFs and ETN and commodity-based currencies. So we have exchange-traded product, and I'll discuss that later. We have exchange-traded funds, and I'll talk about that in detail later. And commodity and currency ETPs have surged in popularity over the past decade. Since the launch of the first U.S.-based exchange-traded fund in 1993, 20 years ago, and it's exploded. It's exploded. The reason? Mutual funds were and still are, they overcharge. They do. They're going to charge you, well, let me just retract that a bit. Because the newer products forced costs lower in terms of mutual funds, in order for them to stay attractive, had to lower their fees substantially. So there has to be what's called parity. In other words, if an exchange-traded fund is charging 0.25% on an annual basis, well, the mutual funds are going to have to follow suit. Why? Well, because exchange-traded funds are just a block of stocks purchased and they're not traded. It's just a block of stocks. It would be a mutual fund with a different name. But nobody's managing, well, I can't say that because there's over 4,000 exchange-traded funds now. They're not actively managed, not all of them. But I suspect there is some management, there is some changes. And again, it's because there's so many choices. You're going to need to read the prospectus in order to understand the trading function. Now, here's something that I learned a few months ago, and it just pissed me off to all know what. Here, I think I'm a sophisticated investor. I've been doing this for 35, 40 years. And I bought an exchange-traded product in the commodity sector, and I've been holding it for 10 plus years. Well, somewhere in the prospectus, and I overlooked it, there was a call function. The sponsor called, this was in April of this year, they called the entire program. In other words, they said, we are cashing this thing out. And I've been holding it for 10 years, and it's been at a lot. And today, that particular product was still there, I would have tripled my money, okay? Because of the commodity back in April or March or April was trading flat. And then it's coffee. I was hedging coffee, and coffee in the last 6 months has tripled in price. So the moral of the story is be careful. If there's a call provision in whatever ETF or ETP you're investing in, then be careful. Because Wall Street is notorious for this crap, and I will never buy, I'll just review carefully the wording of these prospectus. And there's a call feature. It's thrown out the window. It's not something I'd even thought about because it was an exchange traded product. So buyer beware. Wall Street is shady, period. You have too many damn lawyers in there playing this hide and seek game, and they camouflage it with 60 pages of their legal crap. And that's the one side of Wall Street I just despise, is the crap that they pull with their legalese. With that being said, ETPs are listed on exchanges and trade like stocks. They come in a variety of asset classes, such as stocks, bonds, and commodity ETPs. They also employ various strategies to achieve return on investments, including hedging, the use of futures, taking position in alternative investments such as crypto assets, and levered and inverse strategies. I'm going to talk, if I don't already have videos on this, I will. I'll talk about all this stuff. This stuff right here, crypto, no, I'm not interested in it at all. Not at all. I won't talk about it, period. I think it's just a huge Ponzi scheme. And again, you youngsters are going to say you're an idiot, Williams, for not understanding it. Well, I've read all the crap. I've read all the stuff by MIT and the courses produced by Gensler, who is the commissioner of the SEC, who's on his way out. And again, look, there's a lot of zillionaires out there, but then there's a lot of fraud in that particular arena. So share your comments. Tell me why I would be interested in talking more about crypto in an intelligent conversation. Easy as it is to trade ETPs, risks vary for each product. Here you go, risk. I just told you the risk that I was unaware of and the losses, okay? I have made a lot of money and I have lost more. That's just from personal experience. I've day traded, I've traded options, I've traded commodities, I've done it for my clients, I've done it personally, but I will only share what the losses that I've entailed. And I'll have videos on that. But there's one way to make money, and I'm not going to say there's any guarantees, but what's been successful for me is buy and hold. All right, buy and hold. Long term. I'm not going to play the other loss strategies. I have family members that are just so full of crap. They always tell me about their winnings, but never about their losses. And I hear it day in and day out. And basically, I really don't care. I really don't care. I don't discuss any of my specific trading or invest with anyone any longer because it's nobody's business. So with that being said, understanding the VIX, here's the VIX. And here's a thank you for Yahoo for producing this type of information. I'm going to share this information from Yahoo Finance. This is the VIX. This is a 1-year chart. And what it does is it measures volatility. So when you see the market have these crazy ups and crazy downs, you can trade that. You can trade that, and there's a lot of different ways to do it. I'm not going to discuss it here, but you can see how volatile this is. Look at July. Look how crazy this was. Up and down, up and down, up and down, up and down. And what's the variable here? Well, you got to keep in mind what this is based on. It's going to be tied to the S&P 500. If I were to match these two, in other words, compare them, and I could probably do that here somewhere, but I'm not going to. If I look at NVIDIA, Microsoft, Apple, Facebook, or Meta, and Broadcom, along with Tesla, if any one of those 7 or 8 have crazy movements, you're going to see this VIX change up and down, up and down, up and down. This is popular for options traders and the pros. When I say the pros, they stare at the stuff day in and day out. That's their job. They focus on one thing. And as boring as it probably is, they know more than we will ever know. They have, if you were to talk to somebody on the streets, all right, and not the crap that's spewed by Jim Cramer and all the other talking heads on CNBC, these insiders, in other words, the Goldman Sachs, the State Street, Jane Street, B of A, Citibank, Morgan, the whole group, they have the resources. We don't. So if you're speculating, I mean, if you're buying options, you're just speculating. And yeah, I say thumbs up. You're making money. There's a lot of ways to make money. And I encourage those who are making money to continue doing it. Share your secrets. People out there want to know. But I don't do this anymore. I did. And you notice I continue to say that. I used to, but I don't anymore. And then in my other videos, I'm going to say about 80% of the time, if you're trading options, you're going to lose money. But with that being said, the point here is this is a tool measure the volatility. Over here is the S&P 500. Okay, this is the mini contract where you don't have to spend $500 per whatever the market is, 500 times whatever the index is, just to buy one contract. But here's the volatility. You see this crazy thing? So if we were to extend this, and I'm just trying to, probably could transpose this with the VIX, but I'm not going to. Put the VIX over this. So if we were to go to July, remember that? You see this crazy July thing right here? Now if we look here on this, look at this crazy volatility here. We see this huge spike, and look at this huge downturn in July. Well, that's your volatility function. So there's traders out there that will monitor this. And there's just a zillion technical trading tools out there that you can use. But with that being said, this is the volatility. This is why people are scared of the market. They're going, I might lose money. Well, yeah, you might lose money, but look at this trend here. This is a 1-year chart of the S&P 500. Look at this. This is crazy. We've gone from 4,800 to 6,000. Now, if we just go down here, I mean, that's a 5-year chart. If we do this, look at this. And I have commented about this crazy, I think I might have said the 6-year bull run. But look at this. From 2021, here's the bottom of COVID. And this is almost 6 years ago, 5.5 years ago. We were at 2430, and now we're at 6,000. Is that the craziest thing you've ever seen? That is some serious money being put into force here. So yeah, you can lose money right here. So you look at the losses here, and then look at the gains. Now, if we go even further, we go out to what is this? 20, you can look at the date here, 2012. If you were to put your money in the market in 2012, again, this is long term, you can see, and I've commented about this, there's going to be downturns, then there's going to be upturns. And look at the downturns, the upturns. It is just spectacular. That's just the word I'm going to use, is spectacular. If your money was put in here, and if you go even further, you can see how powerful this has been. The trillions and trillions of dollars that have been put into play here. That being said, you're going to face downturn. And for the average investor, you just go, so what? I'm looking at the long term. And if you're looking at long term, you can see that the gains have been spectacular. The downturns, this is a sizable downturn. It's called market timers, and some people want to play that game. I tried it. Again, it doesn't work. Why? I am not in the house. I can't make a market. Goldman Sachs can make a market. In other words, they can move. They can move the market by their trading capability. Bank of America, Morgan Stanley, and many of the others have trading houses, trading rooms, where they can actually physically move the market. And that's the unfair advantage. If you can't beat them, I say join them. I know there's a hypocrisy here. For me, I kind of loathe Wall Street, but in order to secure your long-term retirement, you kind of have to join the game here. So you can do it individually. If you're sophisticated, you have the time. You can look at the many ETFs, or the many mutual funds, or the many stocks. You can do this on your own. I'm not preaching one or the other, but keep in mind you have this volatility, and it's going to be it's a feature of trading. And I say a feature, it's not a bug, it's just market reactions, it's sentiment. And you as a newbie, this may scare you. Don't let it scare you. Just think of it as you own a great company. And that's the key thing here, is buying quality company. Buying something that will protect you against inflation, that will provide a growth opportunity, will provide you long-term stability in terms of retirement or college education, or buying a house or buying a car. If you start now, and for those of you who are 15 to 18 to 20 years of age, and you're mulling around and going, well, I'm looking at YouTube, or I'm looking at TikTok, or what have you. Well, think about investing. Think about putting $50 a month into something and learn. I started when I was 13, and then have continued ever since. And again, as I say, I've lost a lot of money thinking I was smarter than the market, and subsequently have learned that the long-term game is the only way to go. But that's a brief introduction to volatility, and basically what it's going to say is there's just rapid movement in terms of this particular tool. You can monitor it, or like most people, you have a job and this is not something of interest. But the point here is there's volatility in the market. It's called the fear gate. Don't let it scare you. Don't be intimidated by the stock market. It's just a facility where you're relying on professional managers to perform a huge responsibility, and that is running a company. Let me just tell you a little bit about the VIX, if it's of interest to you. The variety of volatility-linked ETPs exists. There is the CBO Volatility Index, the VIX, which I just pointed out to you. The VIX is not based on actual price fluctuations experienced on a given day or over some other time frame, but instead reflects the expectation of stock market volatility over the next 30 days as implied. Critically, the VIX itself is not investable. You'll generally obtain exposure to volatility using VIX futures or other derivatives. For this reason, volatility-linked ETPs tend to track or are linked to VIX futures. While VIX future prices are generally highly correlated with movements in the VIX, they don't track it precisely, and their degree of correlation can depend on the maturity date. The price sensitivity of VIX futures to the underlying VIX may be quite a bit less than you might expect, and this sensitivity generally gets weaker the farther out the futures go. I know this is rather complicated because now we're looking at futures and you're saying, Williams, what are futures? Well, if I don't already have a video on futures, and the links will always be listed below, but what you need to do is you're going to need to go and just go to my homepage, my YouTube homepage. There's going to be a search feature. Just type in something. If it's futures, if I have a futures video, it'll show all the futures. If it's VIX, then something related to VIX will show up. If it's something non-related, if it's budget related, or if it's mutual fund or ETF related, if it's mortgages, again, just type in whatever interest you have. And if I haven't already produced a video, say, Williams, produce a video on this. And if I know something about it, I'll look into it, I'll research it, and I'll do the best I can. What makes the idea of volatility investing tied to the VIX potentially attractive to investors in the VIX historical blah, blah, blah? It's this correlation deal. And if you think you're a timing expert and you see this huge move, you see this huge move here, wherever it was, that July thing here, let's go back here. And if you go, wait a minute, why did this market spike right here? And is that an overbought? And that's a term that's commonly used in the industry. Is it overbought? So if somebody bought the call options here, they made a crap load of money. Then they probably just reversed it and bought puts and said, okay, I just made a lot of money and then I'm going to go on vacation. And then the pros who are doing this, and again, that's what I said, if you are a market maker, I use that word loosely. In other words, if you can push the market, trust me, and I don't have proof of this, but if you're a Goldman Sachs and you have the capability, I suspect they can move this. And I think they do. I think collectively that the insiders have the capability of moving the market, and then there's always the counter, but short-term gains are possible with the trillions of dollars that they have at hand. But anyway, read it if you need it. I could go on and on and on and on. I can ramble forever about this because basically I love this stuff. I love this stuff more. I mean, I just love finance and I love investing. I don't like some of the stuff that the big players do. But for the average investors, you buy, you hold, you buy, you hold. You buy, you hold. Don't play this VIX game unless you're a pro. And there are some talented individuals that make a lot of money, and I applaud them. But then there are a lot of newbies that think they know what's going on. If you're going to play this game, just take baby steps, really. And just be disciplined. There's a lot of rules that you need to follow. And I may show some of the old school rules that I tried long ago. And who knows? Anyway, I'm rambling on, and I do that. So I'm going to shut the heck up. Williams out. Frugal Finance, Brad Williams. Thanks for watching. See you soon. Comment. And as always, I don't want anyone ever to click that like or never, ever think about subscribing. You know, I'm just kidding. Hey, support this channel. You know, give me a little bit of love here and you know, do your thing. Subscribe, hit that like button. William's out. Thanks for watching.